DeFi moves fast, and risk often hides in the details. In this module, we'll build AI agents that watch markets, analyze wallet exposure, and surface useful warnings without crossing into trades or financial decisions. You now have the building blocks: agents that plan, call tools, remember context, connect to wallets, and interact with smart contracts. The next step is judgment. Before an agent moves assets or recommends action, it needs to evaluate DeFi security, market conditions, and protocol risk. A DeFi research and risk agent is not a trading bot. Its role is to collect on-chain and off-chain signals, interpret them, and explain what they may mean for a user's positions. It turns messy protocol data into clear risk context: liquidity, volatility, concentration, and yield assumptions, while keeping final decisions under user control. Trustworthy analysis starts with trustworthy data. RPC calls provide raw chain state, such as balances, reserves, transactions, and contract reads. Indexers add history, including swaps and liquidity changes. Market feeds contribute prices, volatility, and peg health. Protocol APIs add TVL, APR, audits, oracle status, and exploit context. The agent normalizes these inputs, reasons across sources, and turns fragmented signals into one risk report. Think of a liquidity pool as a shared vault with two assets inside. The agent first identifies the pair because that defines exposure. Then it reads reserves. Deeper pools usually mean lower slippage and more reliable pricing. The pricing formula shows how swaps change the ratio. Fees and trading volume estimate income potential. LP tokens reveal the user's ownership claim, while incentives add extra rewards and extra conditions to verify. Liquidity is not just how much money is in the pool. TVL is a useful first signal, but agents need a fuller view: depth for trade capacity, volume for demand and fees, imbalance for hidden stress, token quality for reliability, and slippage for real execution cost. Strong pools usually look healthy across several metrics, not just one. Yield numbers need context. APR is the simple annual rate. APY assumes compounding. Incentive APR may come from reward tokens rather than real trading fees, and those tokens can fall in value or disappear. A strong agent separates fee yield from promotions, then checks volume, emissions, and history before treating any high return as believable. Pool analysis should be a repeatable pipeline, not a one-off query. First, resolve the pool contract and confirm token addresses, decimals, symbols, and fee tier. Then read the protocol state: reserves, liquidity, ticks, LP supply, or any pool-specific fields. Next, combine those on-chain values with reliable price data so balances become USD metrics. Finally, return a structured report with calculations, assumptions, timestamps, and data sources. For liquidity research, avoid giving the agent open-ended blockchain access. Give it narrow tools, such as pool metrics, token price, and protocol TVL. Each tool should validate chain ID, addresses, decimals, and supported protocols. It returns normalized fields like TVL, APR, volume, reserves, and timestamps. The agent then explains the meaning without inventing the underlying calculations. Wallet exposure starts with visible balances, but it cannot stop there. A wallet may hold ETH, stablecoins, and tokens directly, while also holding LP tokens, vault shares, staking receipts, or lending positions. Each one represents underlying assets. For example, an ETH USDC LP token creates exposure to both ETH and USDC. The agent unwraps every position, values it, groups it by asset, protocol, and chain, then expresses risk as portfolio percentages. Not every token balance carries the same kind of risk. Volatile assets, especially small cap or newly launched tokens, bring market risk: sharp price swings, thin volume, and deep drawdowns. Stablecoins have a different profile. They may hold price, but they can depeg, face issuer or reserve problems, fragment across venues, or carry smart contract risk. The key is classification first, then signals matched to the asset type. A token balance can look valuable while being hard to turn into cash. The agent should compare the wallet's position with pool TVL, daily volume, and order book depth. If a user holds $25,000 of a token in an $80,000 pool, selling is not neutral. A 25% exit may be tolerable, 50% may move the market sharply, and a full exit could collapse the price. The warning is simple. Marked value is not always realizable value. DeFi exposure is more than price volatility. A user may hold many assets but still depend on one lending market, bridge, oracle, vault, or admin-controlled contract. The agent should group positions by protocol, chain, asset, contract, and strategy type, then flag clusters that create single points of failure. It can add context from audits, exploits, governance, and key control, but should keep hard measurements separate from cautionary judgments. A DeFi agent should stop at decision support until the user clearly chooses an action. It can say, "Analysis suggests this pool has higher APR," and explain liquidity, volatility, fees, and contract risk. It should not say, "Move all funds now," or imply guaranteed profit. Any swap, approval, deposit, withdrawal, stake, borrow, or risk-changing action needs an approval gate showing amounts, addresses, fees, risks, and whether the action can be reversed. DeFi agents are most useful when they slow decisions down, not speed speculation up. They combine yields, pool data, protocol signals, and wallet exposure, then test for liquidity, volatility, concentration, and exit risks. The key boundary is human approval. Next, we apply that mindset to token swaps and governance.